How can an implied volatility surface be created and interpreted? Have you ever wondered how traders gauge the future price movements of stocks? One key tool they use is the implied volatility surface. Let's break down how this surface is created and what it means for options trading and risk management. Implied volatility is essentially a forecast of how much the market expects a stock's price to fluctuate in the future. It is not something you can see directly, but rather it is calculated using an option pricing model, like the Black-Scholes model. This model takes the current market price of an option and works backward to find the implied volatility. To create an implied volatility surface, you start by gathering current prices for all available options on a specific stock. This includes options with various strike prices and expiration dates. Once you have this data, you apply the option pricing model to each option to calculate its implied volatility. You already know other inputs, such as the current stock price, strike price, time until expiration, and the risk-free interest rate. After calculating the implied volatility for each option, you can plot these values on a graph. The horizontal axis will representing the strike prices, while the vertical axis will show the implied volatility. If you include the time to expiration as a third axis, you create a three-dimensional surface. Now, interpreting this implied volatility surface is where it gets interesting for traders. You might notice patterns like the volatility smile or skew. A volatility smile occurs when options with strike prices from the current stock price have higher implied volatilities than those that are at the money. This suggests that the market anticipates larger price movements. On the other hand, a volatility skew indicates that either call options or put options have higher implied volatilities. This is often seen with put options in equity markets, reflecting concerns about potential sharp declines in stock prices. Understanding this surface is essential for effective risk management in options trading. By analyzing the implied volatility surface, traders can identify mispricings, gauge market sentiment, and manage their exposure to changes in volatility. For instance, if the surface shows a strong skew toward put options, it may signal increased fear of downside risk. Traders can then adjust their strategies accordingly, perhaps by hedging with put options or avoiding excessive exposure to certain strike prices. Creating an implied volatility surface involves collecting option prices, calculating implied volatility for each option, and plotting these values across different strikes and expiration dates. Interpreting this surface allows traders to understand market expectations for future volatility and manage risk more effectively. This process is vital for making informed decisions in options trading and navigating the complexities of market behavior.